Hey, Renter Retires, it's Adam Schroeder here with another episode, and I am joined today because we're going to talk more about taxes by Joe Viery. He is the founder of U.S. Tax Advisor Group. Really appreciate you joining us, Joe.
Great to be here. Thanks, Adam.
Yeah, so tell us a little bit about, we're going to dive into taxes. We're definitely going to get into that. But tell us about how you got into real estate, what drew you to it, and, what was the first real estate deal you were a part of?
Excellent question. Basically, Adam, though, really quickly, this is a perfect time of year to be talking about this subject, cost segregation, especially for those who are on extension for 2003 still. So still have plenty of time to help those folks out who are looking down the barrel of paying income taxes. I got started, I grew up in an entrepreneurial background. I started a business. It has to deal with, if anybody knows what incentive travel is, it's when you do a travel package as a reward for sales. I did that in my own company for over 20 years. In 2000, I sold the company and I started to work for the California Association of Realtors in the financial planning department. And I worked with them for they're members of CAR, California Association of Realtors, and their clients. So that was my universe who I worked with. And then 2007 and 8 came about, and I had just done a cost seg study on 2 clients who had no money to pay their income taxes. I wiped out their over $50,000 of income taxes, and then the cars started going off over the cliff with the Depression, and my position at the California Association of Realtors dried up, and the guy who I had put my cost segs through called me up and said, Joe, you really know what you're doing and you're really good at it. Why don't you come work for us? And as an independent contractor, I went and worked for that company. And I've now owned my own business. I've been, U.S. Tax Advisors has been around for about 7 years.
Nice. Fantastic. Yeah. You saved me all of my money. I want you to work for me. That's a good person you want to hire right there. The person who can save you all of your money. So what led you to taxes in the first place? Like, what about the tax structure is interesting to you that isn't, most real estate investors, they're like, oh, tax benefits. And that's about the extent of what they think about them. So what about the tax benefits actually led to you wanting to dive into them more?
Well, here's the thing is that going back in the day, real estate has a lot of tax planning benefits. There are not just cost segregation, which is accelerated depreciation, but a ton. So going to work with California Association of Realtors, the main topic was how are we going to reduce all types of taxes, not only income taxes, but capital gains taxes. So I got dragged down that rabbit hole to try to help my clients out who had a big capital gains issue or an income tax issue. So that's how I got started. It wasn't a brilliant decision on me. I just followed the lead. And when people asked questions, I found answers. And I was able to help people solve tax problems, property tax, any kind of tax problem. But then when the issue happened in 2007-8, the Depression, bottom line is
the issue. That's the nicest way I've ever heard that described.
Yeah, the issue. But you know what? Here's the deal, Adam, which is really funny, is that when I started, I didn't have a problem it being the industry being depressed. Because I, for whatever reason, had a whole cadre of previous clients who had a lot of cash. So while everybody was suffering, guess what they were doing? They were buying. Yeah, they were buying, and they were buying with cash, or they would refinance, and then the finance would fall through. So they would take over the hotel or the commercial building or the senior center. So I was never really slow. I was busy from day one and have never stopped being busy. This last year, it's a little bit slower.
Okay. So when it comes to taxes and real estate, everybody knows you can do, your mortgage interest, you can do your depreciation, all of those things. So we've talked about cost segs before on the show, but how can a regular person take advantage of that? Like, can cost segs wipe out like any form of passive income that you have, not just real estate, or what can you actually wipe out with the cost seg if you're not a real estate professional?
Okay, so that opens up the topic of like, who do will I advise not to do cost seg? There's very few people out there like that. But one of those that you mentioned, the number one is passive investors. And all passive investors means is you get another source of income from another business venture or opportunity or investment. So, or job, let's say job. So let's say you're a physician and you have an income as a physician. Your active income is going to be as a physician. And now you invest in real estate. Well, that's a passive investment because your active investment is not from real estate. Real estate's only passive. However, we've developed a technique where we can do depreciation for not only the big buildings, which I grew up on, the 20, 30 million, 40, $100 million hotel or commercial building, but we now have developed for the past 7 years a very viable technique to do small buildings, which are going to be like single family homes and duplexes and quads. The reason I bring that up is because what happens when you're a passive investor is there's a limit to how much you can deduct in your as far as losses or extra depreciation. They cap it off. But if you have smaller properties, which a lot of our investors do, like a single family home, it is not enough passive income to go over that threshold. I'm not an accountant, so I'm not going to give you tax advice. So they would have to look up what the passive limit is for their situation. But bottom line is, let's say the passive limit is $40,000 a year. You cannot take any more losses. And let's say that you have a $400,000 single family home. Well, I'm going to give you on a $400,000 single family home about $100,000 in losses. But those $100,000 in losses now can be taken over numerous years. So your max is $50,000 or $40,000. You're going to get that year one, but then it rolls over to year two. So that's why we have a lot of investors who are passive. So in using that same example, however, if you have a big building, let's say you have a $10 million building, and now I give you $2.5 million in losses, and you're the only passive investor, then I would tell you don't do it. Because I'm only going to give you the same $50,000 max, and I'm giving you $2.5 million. Will it come back to hurt you? No, you can always use the losses, but not during your current tax year. Those losses you will feel the benefit of years down the road when you sell the building, if you sell it at all. So that's why passive investment would be one that if you have a huge passive investor, I would tell you it's not going to work.
What all do you need to know as the investor whenever you're going to actually get a cost seg done? Like how much, if I'm a passive investor, I'm buying sight unseen, I've never actually seen the property, had inspector and all of that. What do I need to know about the property to get to you to be able to even do a cost seg study?
Well, you know what? We provide this very easy. Like we make it simple. We provide a no-cost estimate and fee structure. So what's the estimate? I'm telling the folks, okay, with this building, based on when you bought it and what you paid for it and any improvements afterwards that were capitalized, basically here's your benefit. So I gave you an example, a $400,000 single family home, I could find about $100,000 and how much it's going to cost. On the modeling studies, I have a set fee. So let's say it's a current tax year study. The current tax year study meaning that you bought it and you have not filed a tax return. So what does that mean? Current tax year is a little confusing. So if you're on extension for 23, your current tax year is 23. If you filed April 15th or March 15th, that tax year is over. Now we're dealing with the current tax year is 2014. So if you bought a building that's in the current tax year, basically I'm going to give you an estimate, and the fee for current tax year is $700, $700 to $725 for current tax year buildings. So then you're going to look at my example and say, I'm going to give you $100,000 in depreciation, and I'm going to charge you $725. Is that worth it? You do your own. I will give you my opinion, but if you want to move forward or not move forward, I'll leave it up between the client and their accountants to decide if it makes sense to move forward.
Okay. So, whenever you're looking at whatever you're saying, if it makes sense to move forward, I'm assuming that's just looking at tax numbers and everything. But you did mention earlier, if you've got a $10 million building, one person, it might not be worth it. When is it in your opinion, when is it worth it to do it? And how, when you do a cost seg now, how does it impact you further down the road, like whenever you are looking to sell it?
I would say here's the minimum. I would look at any type of building. I would get a no cost estimate, because what we're going to do is you just go to my website and go to the contact page or more information page, and you're going to give us you're going to get a link that you're going to give us the property, your information, and then we're going to get back to you and ask you a couple questions. The questions that you asked before, and I did not answer it completely, is the date you bought the building. Now, why is that important? Because I can go back 15 years from when you bought the building and make the magic still work. About 15 years. So we gotta have to run the numbers and see if it makes sense. So I need the date that the building was bought. And when the building was bought, you've already determined in that tax year filing what the building basis is. You cannot depreciate land. So I'm looking for how much you paid for the building, and that will be on your depreciation schedule, because that's the document you file with the when you file your taxes. That's the method of depreciation, is on the federal tax depreciation schedule. So basically, all I'm looking for is the date you bought it, how much you paid for it, and then I need to know, was a 1031 exchange involved, because there's certain criteria I have to drill down on. And then bottom line is how much in capitalized improvements. Today is the environment's very rich in writing off improvements legally. So I advise everybody to write off the improvements you've done when you fix up the property. Anything you had to capitalize and take over the life of the property, which that's where I come involved. So I accelerate that. Then I need to know how much you spent on capitalized expenditures. And basically that's all I need. You give me that information, I get back to you with the fee. I'll let you know how much the estimate is. You take it to your accountant and say, hey, does this make sense or not?
And you think roughly, with the numbers you've thrown out there, it sounds like you can roughly expect about 25%?
We're all over the map. How we work at U.S. Tax Advisors Group is we look at each property individually. Yes, that's true. So I do need the basic information, the address, and I need, like I said, the depreciation schedule if it's a look-back study. And then if it's not a look-back study, okay, how much did you pay for it? When did you close? And then bottom line is we compile the information. But what we're looking at is we're looking to see if this property will fit into the mold of how we can find the benefit. So, for example, if you have a row home or a townhome in downtown Philadelphia, that means you don't have any land. Your building sits right on the lot line. I'm not going to estimate high because a regular property has, maybe 3,000 square feet of landscaping and driveways and swimming pools and patios. I can't look at that in a row home or townhome in Philadelphia. So bottom line is we look at each property differently. And if it's over the basis of $750,000, we will give you a different fee structure than the modeling or the analytical technique, which is the one that I can charge you only $725. Because the reason I can only charge you $725 is because I can do all my work online. Once you reach the $750 basis barrier, then it's probably going to require more time for my engineers, and I'm going to charge you a different fee.
Okay. So and I know there's a depreciation schedule of a building, residential of 27.5, but what are the things that you're, accelerating the depreciation of? Give us a rundown of kind of what each thing is. And then does it reset? Like if you've got a refrigerator, you're doing it over however many years, does it reset every time you buy a new refrigerator, or how does that part work?
Now you're getting into the accounting questions. I can give everybody my advice, but that's all this is. Basically, if you buy a new refrigerator, you would depreciate that. And that is something that you really don't need Joe for, because the furniture, fixtures, and appliances are either going to be 5 or 7 year, and your accountant should know. They don't need me to put the refrigerator in 7 year for a residential house. If it's in a commercial building, it's 5 year. If it's in a residential house, it's 7 year. A bed is 7 years. All the furniture is 7 years. So you really don't need me. But bottom line is, we will look at the interior of the building, and the interior of the building it falls into two categories: 5 year property or 7 year property. So if it's 5-year property, well, it's mostly 5 years. So I'm going to leave 7-year out because that's things like generators. And, it's kind of rare. We will find 7-year, but let's move within 5-year. 5-year property are going to be flooring, vinyl, carpeting, not ceramic tile. That stays at the long life. I can't put that into a 5-year bucket. Window coverings, specialty lightings, any of that, countertops, cabinets, those all 5 in the 5-year category. Just small sampling, what I just gave you. There's hundreds of properties, of different type of property that we're looking at. Then on the outside of the property is 15-year. The 15-year property is considered land improvements, and the land improvements on a residential building are going to be things like fencing, landscaping, planted trees. So if you bought a home in a forest, I can't count the trees that were there when George Washington, became president. I'm looking at anything when you bought it that was planted by the previous owner. I can look at that kind of landscaping, sidewalks, pools, patios, outside lighting, and so those are all the things we're looking at. And then in addition, as you probably threw out the 25% approximation number for the estimates for this purpose only for your people listening, bottom line is that now tells you that yes, 75% of the building is going to be remaining in long life. It's going to have to remain in 27 and a half years. We're only cherry picking the 25% or so off the building basis. And so what does that mean? That answers one objection. You're still always going to get depreciation. It's just you're not going to get as much as you would have in future years going forward if you have not done cost save. But to get the time value of money, to get that big bump, if I just say you do $50,000 in taxes, that's more valuable than getting a higher interest rate over the next 27 and a half or 39 years. It's just math. The time value money. You want your deductions today, as many of them as you possibly can get your hands on.
Yep, absolutely. Couldn't agree more. So what are some of the objections that you hear to cost segregation? Like when people are like, why wouldn't someone work with you, for example? I mean, is there something about, specific people who just won't do it, or kind of why don't people use cost segs if they can?
Because their accountants don't know that a company like USTAGI, U.S. Tax Advisors Group, has a methodology for doing small buildings. That's number one. You get a small building, a $500,000 single-family home, and your accountant's going to say, oh, no, it's going to cost you thousands and thousands of dollars, which is true. If I have to go to a building and send somebody out there to do all the measuring and documentation, that will cost thousands. But we can do that 99%. We don't need to fly out there if it's a smaller building. So that's one major objection, is accountants just don't know there's a company like ours out there. Number two might be the fee, but because of our automation and our techniques been developed over years, the fee structure, even on when I have to go out and measure a building, is still very affordable. So bottom line is that's two reasons. One would be, and this is no disregard, or I'm not trying to be facetious, but if you're not paying income taxes, you don't need, Joe, don't call me. Because only call me when your accountant or you know that you have to write a check out to the IRS. The last one is going to be the major factor, would be for a 1031 exchange. What happens when you 1031 exchange a property? You can still do cost seg, but the building you sold or the relinquished building, the basis of that building must flow into buying the new building, of course. It's locked into the type of depreciation you're bringing over. So if you use straight line, which you probably did, that stays in straight line. So if you have, let's say, an even exchange, I'll just make the numbers up. You sold the building for $1 million. You bought your next building for $1 million. There's nothing for me to accelerate. The $1 million stays in straight line from the $1 million you brought over to the new building. But now let's say what normally has happened in the past is you sell a building for $1 million, you buy another building for $2 million. Well, now I've got $1 million to accelerate. So if you're doing if you're doing a 1031 exchange, that may be a reason. If you've done a straight exchange or pretty close to even exchange, there may be no meat on the bone left for me to carve out and accelerate.
Okay, I hadn't heard that one before, so that's good to know there. So what kind of tell a little bit about, are most people you're doing these for, is it kind of the mom and pops, or are most people doing these, I'm assuming, are the bigger corporations doing it? How have you seen the kind of market shift? Are more mom and pops starting to do it, or kind of how have you seen the industry change, if any, over the last 5-10 years?
Well, for us, for Ustagi, it's changed because once we developed this, the technique for smaller buildings, and we're one of the few that provide a quality study and the defensible study. We don't charge any extra for defending the report to the IRS. That's very important to know when you're out there shopping around. But bottom line is, we've been doing it for this we call it a modeling technique, an analytical technique. Bottom line is, we've been doing it so much now that we're inundated by the smaller investors, the folks that own 1 to 3 to 4 to 5 buildings. I still have my big clients, the ones that are in the top 50 for senior, top 50 for hotels, top 50 for multifamilies. I still have the big giants. But to be honest with you, we've kind of, Ustagi's kind of segued into a more smaller clientele base of people who need deductions, and they want to get the deductions in an affordable way. So that's really, so I would say that even though we still work with a lot of big clients, we are now more 50-50 with the smaller versus the big ones.
Yeah. All right. And is there any difference whenever you look at it? We talk about the kind of 25%. I'm assuming there's not much of a difference between like West Coast homes and Midwest homes and Southeast homes. Is it all pretty constant, or are the building materials in such that maybe if you're here, you get lower on average? I mean, obviously not exact percentages, but is it fairly even across the country, or is it kind of change depending on where you are?
You know what? Overall, blush answers, it's pretty even all over. It's all over. Overall, it's going to be the same all over the country. However, there are variations, because obviously if you build a home in New England, your slab is going to be thicker, which is going to impact the real property, or the 27 and a half year. You're going to have more allocated to the slab. The process we use is the address to figure that out, to allocate by location. But for the general, I think, discussion right now, if you're talking about a single family home, just that one type of building, you can figure about 25%, could be less, could be, but other type of buildings will give you more return. For example, a hotel or a senior living facility will estimate closer to 30%, and will probably find in the 30s. So like 35, 38%. So the type of building you're bringing to us, depending on how it was constructed, to answer your question, Adam, yes, that will make a difference.
Okay, fantastic. Well, is there anything else we haven't touched on you think is important for investors to know about the cost seg process or studies or anything else?
Well, I think here's one. There's two things I'm going to end on. One is because this buzzword has been going around now since 2017. It's called bonus depreciation. Bonus depreciation is not 100% for tax year 24. It's now dropped down to 60%. Last year in 23, it was 80%. So when I find your deductions, you can take 80% of my deductions. Let's use the 100,000 mark. So what you're going to do is you're going to get probably about 80,000 for tax year 23, and then you're going to get another $20,000 in time over the next couple of years. Now, why am I mentioning this? Because now that 100% bonus depreciation is gone, a lot of investors at first blush are disappointed. Keep in mind, I didn't start until 2008. We didn't have bonus depreciation for 12 years. So it means nothing to me. All it is the time value of getting the benefit. When it's 100%, you get all of it the year you do the study. But if you don't have 100% bonus, you're going to still get the same amount. It's just going to take you a couple more years. You're going to get a big bang the year you do it, and then you're going to get more depreciation. So bottom line is, I would not hold back in not taking advantage of cost segregation because of the bonus depreciation situation. There is a very strong indication and hope that the Senate will pass the new tax bill, and the new tax bill will put the depreciation back at 100%. We've been waiting since Congress approved it. In January. We're still waiting. And everybody now thinks it's going to be, there's a lot of scuttlebutt saying they think it's going to happen within the next couple of weeks. I don't know. I don't care. All I'm saying is don't do it because of bonus depreciation. It's nice, but it's not that nice to get. What was the other part of your question?
Oh, just if there are any other things you wanted to wrap up for the listeners.
Oh, yeah. When you're out there looking, I hope I made it plain. I'm not really popping my company. I am popping accelerated depreciation. It's powerful. It's big. If you're not doing it and you need it, don't run to get it done, because it is magic. It gives folks a lot of extra money in their pockets when they use cost segregation. The one thing I will advise is that our Bible or mantra is a document published by the IRS. It's called the Audit Technique Guidelines for Cost Segregation. Just Google that, Audit Tech or ATG for cost segregation. You'll get a 250-page document from the IRS website, and that tells our agents what to do.
Sounds like a great way to fall asleep at night.
Yeah, no, very boring. But if you really want to know our mantra, that's our mantra. That's why when I say we produce quality studies, because we use the Bible. All of our studies are done by using the Bible. So if you're going to look at another company, just ask them, say, how do you base your engineering platform? How do you what's your methodology? You don't need to know the secret sauce, but just ask them. Mine is simple. We use the Audit Technique Guidelines. End of story.
All right. And now the website is ustagi.com. That's ustagi.com. Tell a little bit about kind of what they're going to see there and kind of the best way to reach out to you.
Well, basically, you're going to get the foundation of what cost seg is. But I think more importantly, click on the button that if you go to the contact us or you go to more information, you're going to get a link that will give us your name and give us your contact information. And then we'll have one of our staff follow up to get the property information we need to give you the estimate at no cost. And so bottom line is, if you want to go through and read all the different services and the website, fine. But I think all you need to do is get your first estimate. It doesn't cost you any money. Then once you get the estimate, then all the rest of the light bulbs will come on. And then between you and your accountant, you're gonna make an educated decision on moving forward or not moving forward.
All right. Well, Joe, thank you so much for joining us today. Again, people, the website is ustagi.com. You can see it right there on the screen. If you're listening in your car or on your headphones, you can definitely check out the show notes. It'll be right there for you to do. So, Joe, thank you so much for joining us today. Really appreciate it. To everyone else out there, if you need to acquire a property to actually do a cost seg study on, head on over to renttoretirement.com. You can see all of our inventory. You can schedule time to talk with us. You can find out everything that we're about right there at renttoretirement.com. And don't forget, if you have questions that you want us to answer in future shows, send them on over to us at podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. Really appreciate the time you spent educating yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.